Inflation, your savings' biggest enemy, and here's how to beat it. Meet Sharma ji. He loves his morning walks and never forgets to drink his favorite masala chai at the street corner. He's been drinking chai at the same chaiwala since 1980. No wonder he proudly regales stories of how the tea was sold at just ₹2 when he first started drinking tea at the shop. Of course, how over the years the price of chai has risen and the cup has shrunk, thanks to inflation. So, what is inflation? Inflation, in simple words, refers to the rise in the price of products and services over time. It affects every aspect of life: food, clothing, education, homes, travel, healthcare, gadgets, etc. For instance, if your monthly expense for groceries, maintenance bills and leisure is about ₹30,000 in 2020, it won't be enough to meet the expenses 5 years from now. So, if we assume a 7% rate of inflation, you will need about ₹42,000 in 2025, ₹59,000 in 2030 and ₹1,16,000 in 2040. But before you brush this aside with the simple logic that prices tend to rise over time, consider this. Is your income increasing at the same rate, if not faster? Yes? No? Sometimes? If your answer is a no or sometimes, then unlike Sharma ji, you won't be able to indulge in your favorites the same way. You will soon be faced with serious questions. What will I have to give up to prevent going into debt? How will rising costs change my lifestyle? And if these issues occur while you still have a job, can you even imagine the struggle after you retire, especially if you rely solely on what you save? Inflation can be your savings' biggest enemy, but it doesn't need to. Be like Sharma ji, who managed inflation by choosing investment solutions that potentially offered higher returns. He wasn't a financial wizard. He didn't do any investment mumbo-jumbo. All it took was a little planning and some discipline. He invested a small amount every month throughout his career in investment options that returned more than the rate of inflation. Some SIPs in mutual fund schemes, asset allocation moves, and voila! You, like Sharma ji, can enjoy your chai throughout your life. You may consult your investment advisor to make sure your investments grow faster than the rate of inflation. An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
For over 140 years, we have partnered India's growth story. A journey with humble beginnings, marked by a meeting of few traders, is today symbolized by a tower that stands for India's glowing financial markets. BSC. Experience the new.
Hello and welcome to Pune semi-final of BL On Campus Boardroom Challenge 2022. I am Srimati Sridharan. BLoC Boardroom Challenge, a unique competition for B scholars, has 3 levels: a preliminary round, a semi-finals across 8 cities, and a grand finale. The online tests in the prelims assess students' decision-making skills and ability to work in teams. Now in the semi-finals, the students will get a chance to meet and compete with the best minds from top B schools across the country and present these strategies. And the teams that make it to the finals will showcase these skills by solving a live corporate case. Now without further ado, let's jump right into the semi-finals. I request Mr. Vinay Kamath, Senior Associate Editor at the Hindu Businessline and Editor of BLoC, to take over.
Welcome all to the BLoC Boardroom Challenge 2022. The unique case challenge for B schoolers is in its 6th year. In the first year of the challenge in 2017, Liba Chennai was the winner, followed by ISB Hyderabad in 2018 and IIM Ranchi in 2019. SIBM Pune won the contest in 2020, while IIM Shillong won it in 2021. Till the 2019 edition, the semi-final rounds of the contest was held in 8 cities at B schools which hosted the event. The preliminary round in all the previous years has always been online, where students are administered a psychometric test to assess their decision-making skills and ability to work in teams. The grand finale, where B schools which won city-specific semi-finals competed for the grand prize, has been held in Chennai. From the year 2020, keeping in mind the safety of the students and others involved in this contest during the pandemic, it has been conducted entirely online, including the semi-final rounds and the finals as well. This year too, we are conducting the event online. Semi-finals case will test the participating teams on the knowledge of finance, marketing and strategy, and the decision-making skills and ability to work in teams, while the case for the finals will test the teams on the knowledge of the financial sector. It will again be a unique event with technology overcoming the challenge the pandemic has brought about. May the best team win the 2022 BLoC Boardroom Challenge.
Thank you, Mr. Vinay Kamath, for the lovely introduction. I now invite Ms. Akshaya Chandrasekharan to introduce the jury.
K.S. Rao is the Senior Vice President and Head, Investor Education and Distribution Development, Aditya Birla Sun Life AMC Limited. Led by his passion for financial literacy, Mr. Rao conceptualized and introduced many of the now successful programs such as Nivesh Mahakumbh, a mass investor education initiative, Fauji Nivesh, a customized workshop for defense personnel, Nivesh Pathshala, amongst others. He was also instrumental in introducing digital initiatives such as Investors Hangout, Friday Finance, Mutually Yours Podcast, Smart Selfie and Mutual Fund Assist, as well as developing unique modules such as My First Paycheck, My First Finance Lesson, amongst others. Under his leadership, Samriddhi, the AMC's in-house magazine for train passengers, was launched and has since reached out to more than 50 lakh readers. He is an alumnus of IIM Calcutta and holds an MBA in finance. He is a certified chartered wealth manager from American Academy of Financial Management and holds postgraduate diplomas in portfolio management and international business. He is also a certified coach from NLI. Vishwadeep Koila is the founder director at Brand Vectors and comes with more than 2 decades of experience in the areas of advertising and communication and FMCG marketing. He is an engineer and a PGDM from Indian Institute of Management, Ahmedabad. Before starting Brand Vectors, he has worked with BBDO, Lintas and Mudra Communications in client servicing and account planning and has handled a host of clients like Ponds, Fun School, Shaw Wallace, Henkel, Ashok Leyland, besides a host of retail clients. After his stint in advertising, he had a long association with Reynolds for over 12 years where he played a pivotal role in shaping the brand to become a household name in the writing instruments and stationery category. As his last assignment before starting Brand Vectors, he was the CEO of Oriental Cuisines Private Limited, a private equity-funded restaurants and bakery and cafe company on expansion mode. He brings to table immense experience in all areas of marketing with a sense of business objectives owing to his stints as CEO and presidents in various organizations.
Thank you, Akshaya. Let us introduce the case study the teams will be tackling. What should be the growth strategy for Environmental Technologies Private Limited? As senior strategy consultants, chart a 5-year path for Envirotech, suggesting what kind of markets, products and investors will help the company maximize stakeholder value. The teams will be marked for 50 points by each jury member. The team with the highest total wins. Here goes the breakup. Understanding of case, 10 points. Case analysis, 15 points. Solution, 10 points. Presentation, 10 points. And teamwork, 5 points. I now invite team 1 to present their case solution.
Good morning, esteemed panelists. Today, my colleagues and me, we are here to discuss about the company Environmental Technologies. The company Environmental Technologies, which functions in the chemical sector, mainly functions in 3 verticals, that is textile chemicals, paper and pulp chemicals, and consumer products. The company here has developed a unique solution, is that they have partnered with a US-based firm and they have created a chemical-free surfactant which is biodegradable and non-toxic. So what this provides the company is a unique selling proposition, as a green solution is the most sought-after solution currently in the industry, and companies which are providing green solutions are getting a lot of traction and lot of visibility in the industry as well. Okay. So in the case, we have been given the market size of each of the country that the firm can potentially diversify into, and the ability of the firm to capture market share in those countries as well. The main objective of the case here is to chart a 5-year plan for the firm. And for that, the firm requires us to work and provide solutions on 5 main tasks that we can help the company with. The current projected valuation for 2022 for the company is 250 crores. So before getting into the quantitative part or the financial aspects of the case and for the company, we have applied a strategic management framework for the company, which is the VRIO framework, which translates into the valuable, rare, inimitable, and organizational aspects of the company. So this will help the company to understand the qualitative aspects of their business as well. So according to this framework, the company, as it is offering an eco-friendly product to its customer, and as the trend for ESG products and sustainability is increasing a lot. So this gives the company a valuable part to its customer. It adds to the value chain for its customer as well. And since the company has developed this technology, it is rare in the industry currently, and no other competitors for them are providing the same technology with the price that they are offering. It makes the product line which they are offering rare for the industry. If we talk about inimitability, since the technology has only been developed by the company, it will be hard or impossible for its competitor to imitate it, or it will be at a high cost for the competitors. The competitors will have to pay more to imitate the product. And since the company provides the eco-friendly product just at a 15 to 20% premium to the chemical-based products, it has given the company a very big edge, as the other eco-friendly products which they get come at a 2 times premium than their price. If we talk about the organizational structure, as my colleagues here will explain further, that we have chosen strategic investors for the company to raise fund and bring them on board. Strategic investors will provide the firm stability and help them in expansion. So this will help them to exploit the organizational structure of the firm. So using the VRIO framework, we have come up to the conclusion that the company has a very good competitive advantage against its competitors, and this will give it a very sustainable competitive advantage going further. Okay. So now I will just hand over to my colleague Dhairya for further presentation. Yes,
For the given case study, we have made some assumption for further calculation, such as USD INR conversion and discount rate. In USD INR conversion, we have taken a past 6-month average price as 77.83 INR per USD. And for discounted rate, we have calculated by competitive analysis methodology to calculate cost of equity as a discount rate. As company is quite new in the sector, therefore, having a debt is quite expensive in a current scenario. Therefore, it has not been covered. NPV as calculated as a 12.11%. Next. Anubhav, next. Company is dealing in a 3 segment: textile, paper, and consumer. And we have made a product segment comparison by calculating NPV of each, in which revenue is calculated from the given data, from which we have derived a gross profit, and to calculate EBITDA, we have subtracted fixed cost from the gross profit. Here we have a discounted rate as a 12.11% as calculated in assumption. NPV in the derived from the given methodology is a 46.34 crores for the textile. Next. For the pulp and paper is 60.75. Next. And for the consumer, 37.55. Comparing these 3 segments in India, consumer is least rewarding and paper pulp is the most rewarding for the company in the current scenario. I would like to hand over further segment for Mohit.
Thank you there. Audible? Okay. Uh, we looked at the calculations, how we compared the three product lines, and utilizing these comparisons, we tried to forecast what would be the total, what you call the top line and the EBITDA for the firm in the Indian scenario. So as you can see on the slide, the achievable top line and EBITDA are mentioned over here. But along with that, the case also provided us with the target that they had for the next 5 years. So we kind of portrayed the difference that would be available if the firm only operated in India. So as to fill the gap, I think globalization is the way to go. And hence, in the next slide, we would try to figure out what is the outcome after we globalize. Thank you, Anubhav. So as you can see here, we utilize the similar methodology that we showed in the product comparison. And the expected market share and the investment required in each region for globalization was given to us. And we used that to compare the profitability. So we calculated the NPV of the cash flows as per the constraints given in each region. And as per the NPVs, this slide showcases the results. So the results are pretty varied. So herein we have the region that is Pakistan and Turkey having a very positive NPV, which leads us to believe that the profitability is very high. The other potential profitable regions are Bangladesh, which has -6, and in Malaysia, Indonesia, Philippines. So herein the NPV is not positive, but it is close to zero. Hence, we believe that within 5 years, we might be close to a break-even point, and say another 2-3 years down the line, we might even turn profitable in these regions. So these regions have been marked as yellow as having potential profitability in these regions. Moving on to the next segment, that is the pulp and paper industry segment. Herein, we did the similar method, calculations for profitability, and we came up with these results wherein Middleist had the maximum potential, wherein their NPV was closest to zero. So herein, this implies that again, it is not profitable in the next 5 years, but maybe down the line, it may be potentially profitable. So looking at these calculations, we believe that globalization can help, but only if we look at the yellow marked regions or the green marked regions. So these 4 regions can help the company. Other regions would pose a very hard scenario for them to penetrate the market or improve their financials and create something out of them. So a 5-year horizon might not be something that should be looked at if we are going in the red regions. Moving on. So using these regions, we computed what would be the firm's potential financials. So the slide showcases the overall financials, wherein the yellow highlighted numbers that have been showcased, and below them are the target that the firm has. Now, what we found that even after globalizing, the target was something that was not achievable. Hence, one of the tasks, I think the first task itself asked us to evaluate whether the targets set by the firm can be achievable or not, or they should be removed or changed. So we believe that using this analysis and a horizon period of 5 years, we believe the targets are too high and they should be reduced. Along with that, we would move on to the company value maximization. So herein the projections for the firm have been given, wherein they give us the financials as well as the valuation movement of the past, I think 10 years from 2012. So therein they have mentioned how the firm's valuation has moved with respect to the change in revenue. So using the same methodology, we forecasted how the valuation of the firm would move with respect to increasing revenue. So that helped us calculate the valuation of the firm forecast the valuation of the firm in the next 5 years. Along with that, herein we also want to point out that the advantages of globalization in the selected regions leads us to believe that strategic investors is the way to go. So we believe that the initial investors should give way to the strategic investors first instead of the financial investors. Also, the fund requirement that is given to us for the next 5 years with regards to R&D expenses, the manpower expenses, as well as the plant expansion requirement. So we believe that these should be fulfilled by diluting the promoter and the ESOP shares. And this allowed us to calculate what would be the final promoter or ESOP share by using the previous year's valuation. So as we can see on the slide, the final promoter or the ESOP share comes up to around 35.32. And this is more than the 35%, which is one of the tasks, that is the fifth task. And this also allows us to maximize the company's value while the promoter reduces their own stake in the firm. Moving on. Yeah. So summarizing the complete scenario that we put up, the 5 tasks that were given to us, the recommendations for each task are mentioned on the slide. So the first task was to compare whether the objectives or the target set by the company can be achievable, or is it right or not. We believe that in 5 years, the target is way too high. We believe that it should be reduced by around 40 to 45%. The second task asked us to figure out whether globalization is the way to go, or whether we should only focus on the India's market. So our recommendation for that is India's market has the potential because the product has the highest NPV in India. So we believe India is the way to go. But along with that, so as to improve our reach and increase the top line, globalization in the selected regions, the 4 regions mentioned, is the way to go. The third task asked us to compare whether industrial products should be taken up or consumer products. So as per our calculations, industrial products do give higher profitability, but consumer products also give a profitability more than the globalization of the other industrial products. So not initially, we believe that priority should be given to the industrial products, but consumer products cannot be removed out of the picture. The next task, which is the task 4, asked us which type of investors we should move forward with, the strategic investors or the financial investors. We believe the strategic investors give much more advantage to the firm with regards to globalization, as well as the stability that they would provide for the firm in the fund requirement, as well as the infrastructural support that they would give. Lastly, the last task asked us how the company's value would be maximized. So in the previous slide, we explained that the company's fund requirement would be overtaken by the dilution of the ESOPs and the promoter shares, and that would allow to maximize the company's stakeholders' value. Yeah. Next slide. Thank you.
You can unshare.
We are open to questions.
Yeah. First of all, congratulations and compliments to each one of you. And it is well presented, well articulated, and put the task very clearly. I mean, I'm so glad and completed on time. Either way, you score on all aspects of it. It's fantastic. And Mohit, this question to you, I mean, little bit of correction, if I am going to a couple of countries, because I'm going global, it's called globalization. And either way, and like if you need to revisit this case and instead of 5 tasks, you have only 1 task to decide whether you want to be, focused, and you will be in charge for it. You are owning the balance sheet. And would you like to be in India, or would you like to have a presence outside?
If I had just, I do not have the option to select where I have presence. Okay.
No, you have a choice. You have a choice.
Okay.
But if you are in charge of your P&L and you have to decide, there's only 1 task available to you. That's only 1K array for you.
Okay. So I believe presence outside would be the way to go.
Okay, why do you feel so?
Because in the short run, 5 years, I agree that the PNL is affected by having a presence outside. But the upside of being visible and having potential new markets that you can go into post the 5 year horizon, that the upside would be something that would help me decide. That's all.
Probably you will get a follow-up from Vishwas sir little later on revenue models. But I have last question to you. This question is choosing between industry products and the consumer products, and you've gone a preference to the industry products. I mean, why it is not a consumer product?
So we base that on a calculation of profitability for each of these three segments. And we believe that the profitability is maximum for the industrial products in the given constraints and the horizon that is. So we industrial products.
Probably I may differ here, but I appreciate your thoughts and well done. And over to Vishwas sir.
Thank you, Rao sir. So I think first of all, as Rao sir also mentioned, congratulations, very well thought through, very well structured, very clear thinking on the whole case. You've gone into the aspects very clearly as to what needs to be looked into in the case and what was expected. So congratulations, team. That's been wonderful. I'm very impressed with the way you have dealt with the case. There are a few things I would like to just A, clarify, or B, maybe point out. So I was slightly confused about how you arrived at just the numbers of what fundraise is to be done, because that seems to consider only the corporate investment requirement. But if you look at it, when you're going this outside the country, I mean, outside which you have recommended and obviously taken the turnovers from there, there's a one-time entry cost of each country. So that you seem to have missed. Because if you add those to it, your fund requirement goes much higher. And at that point in time, your decision on who to go with will also get affected. Because whether to go with strategic or to go with financial will get affected. Because if you go with strategic at that point with raising so much of money, then those guys anyway I was slightly this, because why you chose strategic at this point, it clearly said they want to take 52%. So they can take 52%, then they will have to take all the investors out and some bit of this out. But that's possible if there is not much of fund to be infused. Because if the strategic has to take over that plus infuse the funds, then you would actually end up maybe diluting, I haven't calculated exactly, but maybe diluting the promoters below the 35% mark. So I think that was one thing which I thought, but why do you think consumer is the least of the, profitable or least of the value generating business? What was the reason why? Because I think there was something in the case which did mention that the consumer valuations are at least 3 times that of B2B valuations at any point in time. So if you generate 10 crores of EBITDA and or say 100 crores of turnover in B2B versus 100 crore of turnover in consumer, you are likely to get 3 times more valuation for consumer than in so what is going to happen when you have that? The dilution that the owners will go through is also going to be lower. And as a whole firm, the investors get much better value. No, I mean, you have recommended that we go with it, not that you have not recommended, but you had made a statement that's least. So apparently least, yes, but if you look at the value creation, that would be definitely a good this. Yeah, so just one more. So you didn't mention, so would you like the fundraise to be at one go in the beginning, or are you looking every year fundraise? How would you raise this money? Oh, you said strategics,
Year
so
on
they
year.
will keep putting in the money. So I get it. So okay, fine.
Yeah.
So because the strategics will take over, so strategics would take over right in the right now, straight away. I mean, in the beginning
Yes.
itself. Okay, fine. Okay, understood. So given these comments that I have, I think it's a wonderful presentation. Brilliant, very well thought out and done very well.
Thank you.
Great work.
So
All the good luck. Keep it up.
Thank you. Sir. So your
Thank you,
suggestions
thank
are
you.
very helpful, and we would definitely look into it. Thank you so much.
Thank you.
Thank you, sir.
Thank you, sir.
Bye then. All the best.
Bye.
Thank you, Team 1. We have a special education AV from Aditya Birla Sun Life Mutual Fund.
Life is like cricket. When you get thrown a googly, how you bat is the difference between hitting a six and getting out. A simple example of a googly in life is your laptop crashing while you're working on an important business presentation. If you're smart and prepared, you should have your files backed up on the cloud and should recover from this loss quickly. If you are not prepared, you will have lost years of work. A complicated googly is the 2020 pandemic that shut the world down and disrupted businesses and economies globally. If you already had an online business module or quickly added one, you continued to work like normal. If you didn't, you probably struggled. As organizations, as employees, we try to plan for unexpected situations that could disrupt work. But as an individual, are you prepared to handle googlies like a medical emergency, a natural disaster, a recession, or another pandemic without draining your savings and generating a mountain of debt? If your answer is no, then it is time to set up a contingency fund that can handle life's googlies. What is a contingency fund? Like the name suggests, it is a fund that may help you survive in an emergency. A contingency fund may give you breathing room if your salary isn't paid or if you lose your job. You may not be stumped on how to pay your child's school fees, utility bill and EMI, or worse, if you can put food on the table. How does a contingency fund help in these situations? Well, a good contingency fund is seeded with 6 to 9 months' salary. Do not panic. Yes, that's a lot of money. But you don't need to have it today. You will accumulate it slowly over time. All you have to do is stay committed and only use the fund for true emergencies. This means no spending it to upgrade your phone when it still works or using it to fund that spontaneous friend's trip. How to create a contingency fund? Think of a contingency fund as a systematic investment for unexpected situations. Step 1. Set up a contingency fund account. It can be a savings account, a liquid fund account, or any other type. Just make sure it is relatively safe, easy to access, and separate from your regular savings account. After all, you don't want to spend it accidentally. Step 2. Set achievable targets. When you are playing a match, you don't reach 400 runs on the first ball or even the first over. You keep your team motivated by setting smaller targets that will help you achieve the desired outcome. Similarly, set yourself smaller targets. Once you reach it, raise the bar higher until you have collected at least 6 months' salary. Step 3. Make your contingency fund a part of your financial plan. Analyze your existing income and expenses and find areas which can be tightened to give you a winning outcome. This should ensure you aren't struggling or forgetting to meet your targets every month. Step 4. Set up an automatic systematic contingency fund process. Start an auto debit to transfer your budgeted amount into your contingency fund account. Remember to increase the amount as your salary and expenses grow. Step 5. Replenish your systematic contingency fund. Every time you dip into your contingency fund, make sure you replenish it. This will ensure you are financially prepared to take on the next emergency, if any. Follow these steps with an aim to build a fund that could sustain your quality of life during an emergency. Start today and aim to be prepared to manage any googly that life may bring. An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I invite Team 2 to present their case solution.
Okay, a very good morning to all the panelists. So we are the team comprising of 3 members: Giri, Swapnil, and myself, Diksha. So presenting the case of for the BLoC Boardroom, we had the case of Environmental Technologies Private Limited. The agenda of this presentation is to devise the right growth strategy for Environmental Technologies Private Limited for the next 5 years. So we'll be discussing about the 3 verticals mentioned in the case, which are the textile vertical, the paper and pulp vertical, and the consumer vertical. The strategies that we think are the right one for the next 5 years for these 3 verticals, and our inputs on the 5 questions that were asked in the case. So moving on. Like the first vertical, if we talk about, was the textile. It was the it was established in 2012, and these mills cater to both the domestic and the international markets. And major problems that we see here is that this is very cyclic industry. So if there's anything happening wrong in European and the American markets, this vertical will get affected. Even if there's no recession in India, it will get affected if the European and the American markets are in recession. The second one is the paper and pulp industry, and it was the second, and it was started in the mid of 2019. It is also it caters in the B2B category, and these mills are very performance based, so they get paid when they deliver the certain performance variables that are there. Major problem in this was the marketing of this category because of the high variables, because you have so many raw materials involved, so the marketing of this category becomes an important part. And we will cater to the question if it is the right time to start looking in the European and American markets for expansion without exhausting the Indian market, because that is a large part that we can explore. But given our condition right now that the company is going through, is it the right time to enter those markets or not? The third one being the consumer goods. So this is the latest one that was started in 2021-22, and they have all the excellent products. They deal in the consumer category. To name a few, it was toilet cleaner, dishwashing liquid, and all of that. In this, there are 2 segments: online and offline. So the company started with the online mode, selling their products on e-commerce sites like Amazon, Flipkart, later on to Grofers and Big Basket also. And now they wanted to, so the growth was 6 lakhs a year, 6 lakhs a month, and then it went stagnant. Now they want to explore if we can go into the offline market or not. And the first city that we chose was Chennai Metro, and we are going through the organic and modern trade outlets only for now. And later on, we'll be projecting it for the other cities as well for the future years. Next, moving on. So first, if we talk about the textile vertical, and in this, first we are analyzing the Indian market. So using the data that was given in the case, we have calculated the estimated growth of in revenue and EBITDA, which is your earnings before interest, taxes, depreciation, and amortization for the future 5 years. And we see an increasing trend from 22 to 27. And one interesting thing is that since the company is already present in India, it has no cost of entry, so which helped in getting a higher revenue and profits year on year.
Next, we will see the growth rate, expected market growth rate in China. Since there is no growth rate affected for the textile market, especially in China, even there is a market share expected for the next 4 years, 5 years, we cannot see the positive value in the EBITDA. It takes 4 years if we start a firm in China currently. It takes 4 years to get a positive EBITDA. So because of this, we have excluded China, and we will talk about more in the strategy point. Next. Next, we have seen the calculated the expected market growth rate for Bangladesh also. And Bangladesh, as out of the case, as we know, Bangladesh is a textile hub and there are a lot of opportunities for textile products in Bangladesh. And we can see that in the case data also. Initially, because of the cost of entry and the annual fixed cost, the operating profits and EBIT are going to negative. But after that, it is picking up, and drastically the revenue is increasing, and the NPV is also positive at a 12 crore in crores. Then we have calculated the NPV of all the other companies or countries as well, and different market shares. Since we have calculated NPV to select the positive foreign investments like the countries, and we have observed that only China is having the negative NPV. Other than that, China, all the other countries, India, Bangladesh, Pakistan, and Turkey, have a positive NPV. So we have included them in our strategy, excluding China, because it has a negative NPV. And for calculating NPV, to not discriminate countries anything like that, so we have assumed a discount rate of 10% for all the countries. Next, we will see the pulp and paper vertical, and in pulp and paper vertical also we have taken the data from the case, and in the data we have like in for India, we have seen that there is a very positive growth in terms of for the next 5 years. And since the growth rate is very high, and there is a low annual fixed cost comparing to other countries like China, which has a 6 crores of annual fixed cost, the market share is also increasing. So the operating profits and the gross profit of EBITDA is positive. And the point that we want to mention here is the addressable market share is given for the whole worldwide is given as $17 billion in the subheading, but in the case heading it is $6 billion. We have taken the 16% of addressable market share of the 17 billion of a worldwide and considered it as a for a addressable market share for the Indian perspective, Indian domain. Then moving on, then we have did the calculation for the China also. China again, we can see that the growth rate is low, at the same time very high cost of entry, $5 million, and the annual fixed cost is also high. As I mentioned, it is a $6 million. The overall it is going negative, the gross profit, and we cannot earn for the first 2 years. There is no expected market share. It is a 0% and 0% for 2023 and 2024, and because of which the NPV is also negative. So we have excluded China here in also pulp and paper vertical also. Moving on for the Middle East, it is positive. Initially, in the first year, we can see there is no expected market share. It is 0%, but because of the annual fixed cost and the cost of entry, the operating profits is going negative by $2 million. Because of which the first year we are facing a loss, but later on it is picking up. For the next 4 years it is increasing drastically, and the NPV is positive. And one point we want to mention here is we have converted this $1 million of data into crore rupees, because in the end the objectives are mentioned in a rupees. So we have used the dollar to rupee ratio as 1:81.62 rupees.
So the next vertical that we would be discussing is the consumer products vertical. It is the latest vertical in which our firm has ventured. It started in 2021-22, and it is the only vertical that is B2C. All the previous two verticals were B2B verticals. So this vertical is divided into two segments, the online segment and the offline segment. So in the online segment, according to the data that was given, we can see that for the first 2 years, we are making losses because the total costs, and but after that, we are gaining profits, and the NPV, the net present value, is positive, which means that if we consider this 5-year period from 2023 to 2027, this investment is a positive investment that would add value to our firm. Similarly, in the offline segment also, for the first 3 years, although we are making losses, overall in the 5-year period, we have a positive NPV, which means that for the 5-year period, this is a good investment for our firm and it will add value. So after analyzing all the different verticals and different markets, we have the following suggestions. So for the textile vertical, we saw that apart from China, all the other countries, all the other markets have positive NPV values. So if we look for the long term and try to strategize a 5-year plan for the firm, we should, we as a team, think that we should venture into those markets. So India, Bangladesh, Pakistan, Turkey, Malaysia, Indonesia, Philippines, Vietnam, and Cambodia. All of them are viable and they add a total value of rupees 885 crores of revenue in the next 5 years. In the paper and pulp vertical, we saw that only India and Middle East had positive NPV values. So only these two markets added positive value to our firm in the next 5 years. So we should venture into only these two markets because they together add a value of rupees 616 crores in the next 5 years. In the consumer products vertical, we observe that both online and offline verticals have positive NPV values. So in the long term, in the next 5 years, the investments will pay off and the losses will be mitigated. So we should invest in both. Another question that was interesting question that was mentioned in the case was whether we should go for financial or strategic investors, because both of them have different functions and help the firm in different ways. So since a large part of our strategy is venturing into foreign markets, we would be needing infrastructure and planning, which can be provided by strategic investors. So as of now, at present, if we have to choose between financial and strategic investors, we as a team think that we should go with strategic investors. And the extent of dilution required. So I will be covering this point in detail in the next slides as well. But when we aggregated the total profits of all the verticals across all the markets, we saw that in the first year, that is 2023, we were making a net loss of 15.64 crore. Now, in the case, it was mentioned that certain amount of funds need to be reserved for various things like 6 crores total. And apart from that, in the company objectives, it was given that the EBITDA for 2023 was expected to be 12.5 crores. So since there's a loss of 15 crores, to bridge this gap, and I think to bridge this gap, we need to dilute some of our shares. And the valuation of the company given in 2022 was 250 crores. So if we dilute 11.25% of those shares, we can cover these losses. And that would bring the share of promoters and ESOP down to 36.75%. But in the case, it was given that the permissible limit to reduce their share was 35%. So since it's more than that, I think we are in the green here. So the next 5-year plan would look like this if the suggestions that we presented are followed. So the company objectives that was mentioned, as I mentioned earlier, was this: the top line and EBIT ITDA expectations for the next 5 years. But as per our strategy, in the first year, we are making losses, but after that, we pick up the pace. And even though the figures don't match or exceed the company objectives, we get close and there's a good growth rate. And the dilution calculations are mentioned here again in more detail. So 2022 valuation was 250 crores. We need a total sum of 15.64 crores plus 12.5 crores to mitigate our losses. So for that, we need to dilute 11.25% of our shares, and the remaining shares with the promoters and ESOP would be 36.75%. Apart from the general strategy, the 5 questions that was mentioned in the case, we as a team would try to answer it. So the first question was, are the objectives taken achievable within the given boundaries? Well, we can come close to the targets that was mentioned in the company, but exactly achieving those figures, we don't think it was possible given the situation. The second question is it more economical or capital efficient to first exhaust markets in India, or is it more efficient to start looking at markets abroad? So we think that the firm should concentrate on other countries because after a couple of years, the revenue from India is stagnating and the revenues in other countries are increasing. So venturing into other countries would add a lot of value to the firm. The third question was, should the company continue with industrial products alone, or should it seriously look at consumer products too? If so, what should be the time frames? So this question was asked by investors to the firm as well, because they were skeptical about a B2B firm venturing into the B2C industry. But as we saw in the case, both online and offline segments of the consumer products add value to our firm in the long run. So I think we should take the consumer products vertical more seriously, because the firm has great products that are competitively priced. So even if in the initial years market penetration is less due to more cost of marketing, in the long term it will pay off. The fourth question was, should the company look at financial investors today, or should it go for strategics? We have answered this question earlier as well. Since we need to venture into foreign firms, we need strategy and we need infrastructure. And in both these cases, both these things, strategic investors can help us. So at present, we feel that we should go with strategic investors. And the final question was, how can the company maximize the value for stakeholders by getting the highest value for the company in the next 5 years? So I think this, to answer this question would require a culmination of all the strategy points that we mentioned. So we saw that by following the strategy that we proposed, the firm can still hold a 36.75% stake while fulfilling the other corporate fund requirements that were mentioned in the case. That's it. Thank you, everyone.
Excellent. I mean, good presentation, Diksha, Swapnil, and Giri, and well organized. I'm glad finally you could sum it up what exactly is needed to. Probably, this case set by Vishwa sir, and is an authority on the quantitative side, and I leave that part. And a couple of questions on the qualitative parameters. I mean, if you need to revisit, like there is one on a whether we can go to the global markets, and or we need to exhaust Indian context. If you need to revisit this case, and broadly, if you can look at the agenda is to maximize the stakeholder value. I mean, in such case, are you very keen that you intend to, and the markets which you have chosen is also the markets which may not give the revenue you anticipate? And what is the, if you have to revisit this case and do only one part of it very seriously and deeply, what could be your answer?
Sir, I will take the question. First of all, we have calculated the according to the data given of the expected market share in all the other countries. We have seen in the graphs as well, on the NPVs as well, that these are the most viable markets apart from India. Like for example, in textile, Bangladesh, if you see, and Pakistan, if you see, they are giving a very large profits and revenues. But whereas that if you go to China or other countries, the values that they are adding, the revenue that they are adding is very low. So adding the revenue will make the most of the for a maximizes the shareholder value for the firm. That is what we believe, and that is why we have selected those countries especially.
Thanks, Giri. I mean, thanks, Giri Charan, for it. And Swapnil, then, when you are talking about the end conclusion, you said about the strategic investors and the dilution of the stake. Would it be you are thinking that immediately or little later?
So according to the data, we saw that our company was making a net loss in 2023. And in the case, it was mentioned that certain funds need to be allocated for various things like team building and infrastructure. So the 2023 requirements was 6 crores. And apart from that, the company objectives was that 12.5 crores of revenue should be EBITDA, 12.5 crores of EBITDA should be present in 2023. So even if we don't fulfill the 12.5 crore figure, we need 6 crores set aside for our for the functioning of the firm. Since we are making a loss of 5.6 crores something approximately, I think we need to dilute at least some shares in 2022. And in the case it was mentioned that the firm is looking for investors in 2022. So I think it is a good time for that.
Okay. Thanks, Swapnil, for this. And this will be the last question from my side to you, Swapnil, once again. It's, when you are summing it up, the last slide we put the objectives is almost nearly to reach. Is it nearly to reach, or like, is there is a wide gap? I mean,
the gap widens as the years go by. That is true. But in the initial 1 or 2 years, we were close.
Okay. Thank you so much, and thanks for those answers. All the best, and over to Vishwa sir for the next part of it.
Okay, so thank you. And as Rao sir mentioned, very well, analyzed, and you've gone into each country and looked at whether it's worth getting into each of the countries or not, and you've taken decision based on that. So your approach is good. Maybe some errors in this, but that's very important. I'll just try and point some of them out, because you are a consultant, and even if there is a calculation error, you could be giving a wrong decision to the board or the management. So one of the things right in the beginning, you said there's an other things Rao Sahab has already looked into, so I'll just get into this. You said the company has to dilute 11% and to get the money, right? Based on the valuation that you have got.
Yes, sir.
So how does the founders go from 48% to 36% with 11% dilution? What is 11% of 48?
It is 11.65, I think.
11.65%. So when they dilute, everybody will dilute, right? Not only the promoters. So promoters will dilute 11% of 48%. So which is only 4.8 or 4.9, 5% only they will dilute. Why will they dilute 11%? They are currently 48%, right?
Yes.
When the company dilutes 11%, other investors will also dilute 11%, and the investors will also. So what will company?
Okay, so
what would the investors? They will only dilute 11% of their current stake, right?
Okay. Yes.
So that will provide you with more scope to dilute further and go later. And why your answer would have been completely topsy-turvy and gone wrong if you had actually considered something which you have missed. You are talking of only the investments. You have looked at only the investments which are corporate investments, which is 6 crores, 15 crores, and all those things. But the case mentions that there is a one-time entry cost of each country.
Yes, so we have added those in the table.
No, so that you added in the table to calculate the NPV.
NPV.
Yeah, but
and
by calculating
EBIT.
But this is not the way to calculate EBITDA. It is an investment. So investment sits in the balance sheet, and it doesn't sit on the P&L. So you can't put it into the P&L. So it's balance sheet. So second thing that you have to do is, with this, you have to calculate the fund requirement throughout. Having a positive, NPV could be because you have a lot of negative in the first 3 years, but a lot of positive in the next few years. So you'll get a positive NPV at the end of the thing. But if you run out of cash because of the negative EBITDA in the first few years, how will you run the business?
Yes, sir. So that's why in the last slide, we in the 5-year plan slide that we showed, we calculated the aggregate revenues and the aggregate EBITDA across all verticals, and we were fulfilling the corporate fund requirements at least. So
yes, you were fulfilling the corporate fund requirements, but you were not fulfilling the entry individual cost of entry. You have taken so many countries, so there are a couple of $1 million of entry cost into each of those. So if you consider that, then you will have a problem. So if that happens, it may even impact your decision whether you want to go with financial or you want to go with strategic. Because at this point, you go with strategic, you may not be able to raise that kind of a money without diluting the promoters to the lower. So you've done a good analysis. I mean, a great analysis. Everything is fine. But, the importance of making sure that you don't miss out, some of these even critical aspects, because it could suddenly change the whole decision.
Right, sir.
And
Thank
that's
you
important.
for pointing out, sir. Thank you. We'll take care.
Yeah. So that's fine, because as you go into the industry, the scope for making errors is almost zero. So you will be held responsible for every decision that you make, right? Yes. Great, but very nicely done. You've analyzed. Your method was correct. I mean, some errors, but your method was very correct, and you've done a very good job of analyzing it.
Thank you.
Great. All the best, team. Good.
Thank you, sir.
All the best.
Thank you, sir.
Thank you, Team 2. We have another special education AB from Aditya Birla Sun Life Mutual Fund.
Benefits of SIP, STP, SWP. Win with SIP. This is Sid. He recently started working and wishes to invest his money in the stock markets. But his salary isn't much, and he has only a small sum of money left to invest every month. While he was contemplating on what he could do, his elder sister Reena came to his rescue. An avid investor herself, Reena introduced him to the magic trio of SIP, STP, SWP.
Don't worry, you don't really need a large amount to start investing. You can invest as little as 500 rupees weekly, monthly or quarterly using SIP, that is Systematic Investment Plan in mutual funds. And before you wonder how it could help, let me tell you, a SIP has many advantages. 1. It lets you start small. And when you invest every month, you average your purchasing cost. So, you needn't worry about timing the market. For example, let's assume you invest 500 rupees every month. Given the market volatility, the cost of purchasing a unit of a mutual fund will change every month. Say, in the first month, you may get 40 units for 500 rupees. In the second month, you may also get 25 units for the same amount and perhaps more in the next month, say 45 units. This difference in price averages out over time, giving you the best possible price per unit over time. 2. You not only make your money work, you also make time work in your favor by starting to invest sooner than later. 3. You also benefit from the power of compounding by reinvesting the profits earned from your investments in mutual funds. Let me explain. Suppose you invest 500 rupees per month for a year. In 12 months, you will have invested 6,000 rupees. Let's assume your money grows at 8% during the year. So, your investments will be worth 6,480 rupees at the end of year 1. Now, if you leave the entire amount invested in the fund and continue with your SIP, by the end of the second year, your investment would be 12,480 rupees. That is 6,480 rupees plus 6,000 rupees. But given the 8% returns, you would have earned a profit of 998.4 rupees. And this amount will continue to compound as long as you stay invested.
This is quite enlightening. But sis, I have a doubt. When I get a bonus at the end of the year, how do I invest it? I don't want to take the risk of timing the market.
I'm glad you are catching on, Sid. You just need to be smart with your investments. You can park your bonus in a low-risk debt or liquid fund initially, and then set up a STP, that is a systematic transfer plan, which will transfer fixed amounts from this scheme to other debt and equity schemes regularly and give you all the advantages of a SIP. So you don't have to worry about timing the market. And while the SIPs happen, your money isn't lying idle in your bank. It is earning interest in debt or liquid fund. And just like a SIP, STP allows you to set the duration of your investment period. For example, if you get a 50,000 bonus, you can choose to invest 5,000 in a single scheme or 1,000 in 5 different schemes over the next 10 months. You can make this choice based on what goal you wish to achieve.
You have a solution for everything. I have one more question though. I can keep my investments going every month, but how can I withdraw, say after 10 years, without the hassle of timing the markets?
Well, Sid, this one is easy too. Let's assume you are investing for your retirement funds. Once you retire, you can turn your SIP into a SWP, that is, a systematic withdrawal plan, and get a fixed income at regular intervals. So if you need 25,000 rupees per month to meet your expenses, you can set up the SWP to deposit 25,000 rupees into your bank account every month or 75,000 rupees every quarter. SWP gives you the flexibility to choose. A SWP not only aims to give you protection against market volatility, it keeps your money working for you. So, you see, when you SIP, STP or SWP, you aim to win on multiple levels, today as well as tomorrow.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I invite Team 3 to present their case solution.
Good morning, sir. So as per the case study, actually, we have decided to move forward with the consumer durable product segment. So we have decided to go forward with the consumer product segment in the B2B market, B2C market, because since actually the case it has already mentioned that in the textile industry, we need more R&D so that the product performance can be improved. And in paper and pulp industry, since there's a lot of parameters that are not under our control, so the company can't become more profitable in that particular segment. So we are decided to diversify into B2C market via consumer products. So we will first target in the Indian market itself. As it has already mentioned, there is untapped market of 60,000 crores, 60,000 crores in the home cleaning solutions segment. So we will be first tapping into the Indian market via the marketing strategy, which we'll be presenting here moving forward. So we will right now the textile and pulp segment that we are catering to will become self-sustaining because EBITDA is already turned positive in the for the company at particular time right now. So the B2B segment that the money that comes in will become self-sustaining and that domain will take care of itself. So we will be needing investing mainly in the B2C segment of consumer durables, consumer products. So we will moving forward, whatever we will find financial investors because we are not venturing into abroad market. So since we are only concentrating mainly on the Indian markets, we don't need the infrastructure that will be provided by strategic investors. So we'll be mainly concentrating on financial investors for financial support, and the financials will be explained moving forward by my friend. Then okay, so we are thinking of moving forward. We are thinking of implementing G-Stick frameworks in which we for the marketing, in which the main steps is goal, strategy, tactics, implementation, and control. So our companies right now, the goal that we need to focus mainly on is the revenue growth through the brand appreciation. Since ProEarth has also got Green Pro certification, we can capitalize on that and we can move our products. And even moving forward, the projections, the number of products is going to be increasing as well. So we will mainly aim towards the revenue growth and capturing as I told, capturing the untapped market share of 60,000 crores aggressively because we have a product differentiation, value proposition of our product, as well as cost differentiation as well. To benchmark that, what we need to do is we need to create awareness of the eco-friendly products. Via our marketing, our main goal will be to create awareness among the customer regarding what is the true eco-friendly products and what are just portraying themselves as eco-friendly products. And also we need as online market all over the India, our sale can take place, but there will be a lot of supply chain problems because if if we have only one plant, only one storehouse in Chennai, so shipping all over India will become a huge problem, and it will create unnecessary cost in supply chain in a supply chain. So to optimize that, since we are planning to expand to all the major cities like Bangalore, Chennai, Pune, Kochi, Delhi. So since all the stocks is going to be, we'll be creating warehouses in different major cities. The online operations, online sales channels will get a boost, as well as our cost will be reduced. So we are thinking, we will moving forward, we will establish our product, and we will diversify into major metropolitan cities as well. So as per strategy, we'll be targeting middle class families. Since COVID, people have turned towards hygiene, so people are more inclined towards buying chemicals and cleaning products, so that they will be they will be they will stay healthy. So we will target mainly on middle class families, since our brand offers only 15 to 20% more price than the chemical counterparts. So we will capitalize on that. We can create, as we are planning to create awareness. We will use this to our advantage, and will target middle class families. Our competitors mainly will be residential, industrial cleaning counterparts, chemical manufacturers. Since as we are creating awareness, we can highlight that the chemical right now, actually, in whatever the product we look into, in every product chemical is present. So by creating awareness, we'll point that out, mainly we'll stress that out, so that people will get to know the harmfulness that the chemical causes. So when they move to biodegradable products, the positive takeaways they can get through it. Our primary cooperation will be, we aim to improve and advance both environment and human health by offering high quality. Since we already have Go Green certification, this is almost fulfilled by us. And as per tactics, our product is home clean solution brand is, so as I already mentioned, the price is 15 to 20% more than the chemical counterparts, and all our biodegradable same segment competitors are double the price that the chemical counterparts are offering. So as our marketing channels, we will use communication such as endorsements as well as influencers. The complete marketing plan will be taken over by my friend Arshin right now.
Good morning, sir. My name is Arshan Mahajan. I will take care of next slide. That is implementation. So for implementation, we have two points, that is development and deployment. So our major task is to demystify marketing gimmicks that is present in our current market. Every brand try to present itself as an eco-friendly brand, but in reality, it is not that up to the mark. So we need to demystify that, and we need to take care of the awareness of our product through displaying the product composition that we have, and keeping them aware about our composition. So for that, we have deployed two strategies, that is inbound marketing and try and buy strategy. So explaining next is inbound marketing. So the main purpose of deployment is to adding value at every stage of customer's journey, so that it is fulfilled it at every journey, at every step. So for inbound marketing, we have three steps. First is attract, then engage, and delight. So for attract, we need to first do the search engine optimization. Whenever a customer search about any eco-friendly product or any eco-friendly cleaner or cleaners, we have to present our brand on the top search results. So that could be done easily with search engine optimization and Google Analytics. And through influencer marketing, we can easily engage more customers in social media platforms like Instagram, YouTube. So we can engage more customers through that, and we can present our brand and how our values through that. And also by using our Pro-Earth blog slide, we can add the values of how eco-friendly products are essentials for our Earth, how climate change is affecting the Earth right now, and how it can help right now. So for the second part, engage, when we have these customers, when we have engaged all of these people, we will be extremely personalized in their needs. We will identify what they need, and we'll suggest them products according to that needs. And we'll give that through bots, live chats, and messaging apps such as WhatsApp. We can do WhatsApp marketing, or if it is Instagram, then we can contact them through personal DMs. Then we have delight. when the customer is present, when the customer is acquired, we will do like, we have to repeat the orders. So we will do email and marketing automation. And these all the things can be done through analytics such as HubSpot analytics. We can partner with HubSpot or similar to that, and we can easily do that inbound marketing. And second strategy is try and buy marketing. In this, we will target the tier 1 cities first, and we'll do vending machines in major malls or outlets of the city, and we'll try targeting sampling without wastage. That will engage the customers through their mobile app, and we'll get their data, like basic data about email ID, phone number, and we can engage with that later on. And once we have the data, then we can analyze the potential leads, what they need, and what sample they require, and we can easily do the extremely personalization, and the inbound marketing cycle can go on to that also. For this, we can easily partnership with iSamples or any similar lead. Next we have is control. In control, we have monitoring financials, costs and sales, and monitoring market for any new player entry. We have to regularly monitor what are the financials going on, and is there any new player which is going to enter in the similar center with similar costs and benefits. Now my friend Ami will take over.
Hello, good afternoon, sir. Am I audible? Hello.
Yes, you are audible. Yes, you are audible.
Very much awesome. Good afternoon, sir. Sir, now I'll be presenting you the financial aspect of our project. So, in the financial side, the basic premise of any the basic premise of any financial statement are two things: the assumptions on which it stands and the principle of conservatism. So we have tried to incorporate both the principles into our financial slide, wherein we have taken reasonable assumptions. We have changed the mix a bit. That is the reason we are presenting it again in a different format. We have given a bit more weightage to our online sales side and a little less to the offline sales side. Since the sector is around 60,000 crores, and if we look at the present conditions, the growth rate is around 5.02% CAGR. So it's a growing market, and we are one of those firms which, those few firms which have both the advantages, the cost leader advantage and the product differentiation advantage. And in this financial assessment, we have not taken into account the pricing cushion we have. We are pricing ourselves at around 15 to 20% more than the cost, and not around the double the price which is done by our competitors. So the growth has been taken to around 2.2 times, with increasing in 20% per year. For offline sales, we have taken 1.4 times and increasing by 0.2 times every year. The reason being, since we are looking at a capex investment, the initial takeoff for the offline sales will be a little slower, but it will go for the kill in the years to come. And hence you can see, sir, we have arrived at our profit figures as well. Now, our startup is at a growth stage. Currently, we are a bit away from the maturity stage. So the valuation which we'll put on it is based on the revenue multiple. We have considered a reasonable revenue multiple of 5. In the previous year, in 2017, when the company raised money, they had a revenue multiple of around 6.2. We are rationalizing it a bit, because as and when the company earns profit and goes towards the maturity stage, the valuation model will change from revenue multiple to DCF model. That is the reason we have reduced our revenue multiple. Now we have kept a revenue multiple of 5. And if we look at our projections in the last line on pre-money valuations, we are looking at around 8,422 crores of valuation, which will hopefully at the present rate make us $1 billion startup. We are 5 years a bit later, and if you look at the trajectory journey throughout, it is a bit later that we have arrived at this stage. But one thing to note is that if the assumptions hold true, we will arrive at $1 billion level with substantial, significant profits at our back. Now, sir, we look at the equity stake aspect. The case study had categorically asked us to look at the valuation at which we want to raise money. So we are looking at a pre-money valuation of 263 crores. Since we already hold around 48% and our existing investors hold around 52%, we cannot go beyond 35%. So we have a cushion of 13% with us. Now, we as a team are planning to use this cushion in 2 branches. The first tranche will be currently. So we'll raise 6% of equity at the pre-money valuation of 263, which will be around 15.75 crores, which will fund us for the next 3 years. We are planning, since this is becoming a corporate company in years to come, a genuine corporate company, we are planning to fund some of our growth with the profits on our back. And also we'll have a 7% cushion left after using the 6%. So in year 3, that is in 2025, we can still look at raising reasonable amount of money with a higher valuation, and keeping our both the options open towards the end of year to 2027, whether to go for an IPO or go for a strategic investor consolidation. That's it from our side, sir.
Great to see all the three of you together, and good show. And thanks for those presentations. So, like, no, Ameya, Harshit, and who is the third person's name? I couldn't get it.
Harshit.
Ameya, and
just a minute. Just a minute.
Are we audible to you?
Yes, sir. Yes, sir. Yes, sir.
I'll not put much questions because of the audibility and qualitative aspect. I'll have a couple of things, but on the quantitative side, Vishwa sir can have those questions, and very interesting questions will come to you. I was looking at those data, and probably the one thing I would have felt is you did a lot of good work. Probably it could have been a little structured well. While analyzing, I mean, you put everything. Maybe you wouldn't find much time to change it at the last minute, and are the bit of a last minute preparations would have gone. Only one question, which is you've just touched and gone. I mean, if you have to look at there's a task which is given to you, one of the tasks, but there's a task at 3 which was talking about whether you would like to focus on consumer products or the industry products. Given a chance, if you have to, I mean, I was just looking at that data. I mean, what is that your choice for it? It's would you like to continue with industrial products, or you seriously look at consumer products?
Sir, as I mentioned, sir, industrial products right now, see the EBITDA has turned positive right now. Since we are getting revenue from that both industry as well. So whatever the R&D needs that we have, we can actually use that fund to fund our R&D activities. So, but that won't generate us that much profit. So we are seriously considering into moving consumer products segment, sir, B2C segment. Since they already mentioned that if for the same turnover, if the company becomes a B2C firm, the valuation will triple. That's the reason our main objective is to maximize our stakeholders' profits. So that's the reason we are seriously considering to moving towards B2C segment.
Thanks, Ashit, for that. And the last question to you, I mean, this is regarding the focusing on exhausting the Indian market vis-a-vis venturing out. I mean, given a choice, if you have to rework, and if you are the CXO and you are owning that P&L, what could be your choice? It's not a case study, but if you are really into that, what you will do? Your neck on the block.
So can you repeat just the last 2 statements?
No. If you are the CXO of that company and it's you're not presenting the case or recommending and going, you're owning it. If you have to own, what you do?
Sir, as per my understanding, sir, before going to foreign markets, I think we should get rid of the inefficiencies we have in our current market. It is on our goodwill and on our work in the current Indian market on which we can back upon and go to foreign market. So unless, as per our projections, if I have not exhausted a very reasonable value of our current 60,000 crore market, which is growing, till then I would observe. I would be a keen observer. I wouldn't shut my doors completely to it, but I would be waiting and watch. I would play the wait and watch game and not kill my option.
Excellent. Keep it up, and really impressive. All the best. Over to Vishwas.
Thank you so much.
Thank you. Yeah, good team. You all have put your heads together and done a lot of analysis. I mean, a lot of recommendations. The only thing I would like to point out is that see, every case has a particular objective. When a case is given, like as much as when you are doing your case studies in your classes, the case is meant to teach you a particular subject or a particular aspect of a subject. So similarly, the case is always there. It's important for you to figure out that particular as to what is this case trying to tell you? And what is it that I'm supposed to learn out of this case? What I would do differently from you, I would, rather than, pointing out, because there'll be too many things that I'll have to keep, pointing out. If I were doing the case, I would do it differently, that there is so much of data given, which tells you the real market situation. I will not try to assume things from the market, because if they was to be assumed, I would leave it open. I mean, the case would leave it open for you to assume it. And then you keep assuming everything on that basis. There's so much of data given as to what happens in each country when you enter, what happens to B2C, what happens to B2B. If you stick to the case facts and you stick to the case numbers, your solution would be very different, because you'll never be able to get these kind of turnovers that you're talking about. Your turnover you're getting only because you just assume that because it is a big market, because it is this, then if that you assume, there's the other side of it, that there are so many players, including players like ITC, struggling at less than 1% market share after 10, 15 years of being in this industry and pumping in thousands of crores into advertising. They're still struggling at sub 1% in these cleaning products and personal products industry. So it's very competitive. It's very competitive. Not easy to break in. So considering all these, I think a good mix of understanding what this data told you. And so first, what one has to do is, let's take the data and then analyze and figure out what is the solution that is coming. On top of that, then you can put your qualitative understanding or qualitative aspects for what you want to put, and then say, because of so and so reason, I would like to tweak this. Or because of so and so reason, I'd like to tweak this. But first, what data has been given, that has to be analyzed, and that has to be, you have to come out with a solution. So I think that would be an important part for you, because, you're going to be walking into the corporates very soon. And when you go there, people are going to look for what is the backup, what are the number backups, how sure are you of whatever you are recommending. When you're recommending something, there'll be a CFO, there'll be a marketing head, they said, all of them sitting there with they have numbers right here, all the numbers, and they're going to keep throwing numbers at you and figure out whether you've considered everything before coming out with a strategy. So, first 5 minutes itself, they will kind of destabilize you by throwing numbers which you will not know, you would have not considered. And then they will say, oh, if you've not considered this, then where is your solution coming from? So numbers are important. And when numbers are there, please make sure that those numbers are, considered. Okay.
Sir, have you really take these considerations to greatest of importance, sir? Just one, I'm just sharing this because we really want to share our thought process with business leaders such as your good self, sir. Is that we have arrived at these assumptions by looking at some of the competitors which were there. There's a global bees brand. We have gone to MCA website. We have taken their PAS 3 and 4 certificates, and we have analyzed their growth rates, and then we have sort of tried to stick to a trend line. We tried to make it a trend. Obviously, there will be some amount of variations, but this would be the general trajectory, sir. But we do keep taking into account the aspect.
Sure. Good.
Well done. A lot of hard work. Good luck.
Thank you.
All the good luck,
sir.
sir.
Okay.
Thank you, sir, for your time.
Thank you.
Bye.
All the best. All the best.
Thank you, Team 3. We have a special educational AV from Aditya Birla Sun Life Mutual Fund.
Nivesh Fables presents Choose Your Advisor Wisely.
There were two rabbits. Willy was the wise one and Fred was not so wise. They were walking through a field and came upon 2 carrots. Fred excitedly rushed and picked up a carrot, but it was smaller than it looked. He was confused, so Willy said, "Judging a carrot by its leaves is not the right way." After walking for some time, they came across another set of carrots. This time, Willy chose the carrot first. Fred thought, "How come the carrot with smaller leaves is small?" Willy replied, "I do not judge a carrot by its leaves." For the third time, they found 2 carrots again. Willie pulled out 1 carrot and offered it to his friend. Fred was still confused and said, "I don't know how you do it, but I guess you're just smarter than me." "Fred, I may have the wisdom, but I share it with others and help them benefit from it too. You're my friend, you trust me, and I want you to have this carrot." In real life, while making investment decisions, don't we all look for an advisor like Willie, who wouldn't just look at the leaves superfluously, but analyze, inspect, understand the investments thoroughly, and suggest the right one for us? Someone who we can trust our hard-earned money with. As they say, if you look for a financial advisor, look for someone with the heart of a teacher and the soul of a friend. Have you found yours? An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We will now have the comments for each team's presentation, followed by announcement of the winners for today's round.
So once again, a nice bunch of teams that looked at a case which is pretty complicated and broke it down into decision-making units. Very happy to see all the 3 teams doing well, but a couple of teams really went deep into the analysis, looked at the number, used the numbers very professionally, and arrived at their recommendations. What was important, and which is good to see, is that at this stage in their career, which is or at B School itself, they are able to understand how the corporates think and what kind of decision making happen, which is a very encouraging thing. And I feel happy that there was more than one team which met beyond the standards which at least I was expecting. I was very happy with the outcome of today.
Thank you. Thanks once again for this opportunity. It is always very engaging to connect with these boys and girls. Today it's another day to look at each of them coming with very competitive way, and each of the teams have come very well prepared. Probably on the qualitative aspects, yes, they are reasonably good. Quantitative, they may have to some, but as Vishwa sir said, 2 of the teams exceptionally is done today. Even other team is reasonably good. Wishing all the 3 teams good luck, and each of them, my compliments to each one of them. And today's winning team is SIBM Pune, which is really exceptionally, they are not first among the equals, but they have come out little more better. I always look at is, whether it's their understanding of the case or the way they analyze the case and coming out with the solution and the approach to the presentation and the collective teamwork. All that put together, it is they're standing apart from other teams, and wishing SIBM Pune good luck for the finals, and all the good luck for other team members in their careers. And thanks for this opportunity to in the Businessline and team. And it's my compliments to Vishwa sir for putting such a complicated case. But the students have given other way around, however complicated, they are very competitive that they can resolve and solve. We are glad these are the future industry leaders.
Absolutely, very happy to see that.
Yes, sir.
Thank you for watching. This is Businessline on Campus Boardroom Challenge 2022.